Okay, welcome everyone to another webinar brought to you by optionslam.com. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. You should be able to see the CFTC rule. I believe there's a new CFTC rule. I believe it's been updated here about a week ago. So this one might not be as current as it should be. So I need to get that updated. Look it up. DuckDuckGo it, right? DuckDuckGo it. We don't Google anymore. Now we DuckDuckGo. Our disclaimer tells you that we are not licensed financial advisors. We are not registered investment advisors. We do not provide investment or financial advice, nor do we make investment recommendations. The webinars provided are for informational and educational purposes only. Any trades you see illustrated in these or any of our webinars are not a solicitation to get involved, to engage, to buy, to sell. They are for illustration purposes, educational purposes, informational purposes only. Do not trade the trades that I illustrate in these webinars. You will lose money. How's that? I am Marko. This is my email address, optionslam.com@gmail.com. Please send me your feedback, your questions, your suggestions. Love to hear from you. I answer all the emails myself personally, almost all the time and promptly. So I'd love to hear from you. So 2 weeks ago, we had a webinar. 2 weeks ago today, we had a webinar. And in that webinar, I illustrated a trade to teach about, and this isn't the first time. I brought the ZIMS strategy up a while ago. Maybe, I'm going to say maybe 2 months ago when I first brought it up. Let me jump over to optionslam.com website a minute here. Here's the optionslam.com website homepage. You can see I'm not logged in. Even if you're a free member, there is much to be utilized here as a free member. I am not logged into my insider account. I'm as if I was a free member, not not logged into an insider account. I can go to PLTR, which is the stock that that I illustrated a ZIMS trade on 2 weeks ago today, and you can see there's some information here about the November 4th earnings event, all this information, and the previous earnings event. So there's 2 earnings events that you can get full information, not just on the earnings history page, but the trend analysis page, which has all this data is filled in for you and available to give you a sample, and it's usable data. The implied move weekly page. There's prompts here to become an insider member so that you can have access to all the data, all the earnings data, all the way back to, I believe, back to 2002 in some cases, you know, stocks that have been around for a long time. Not only the data on all these different pages for Palantir, but even the predicted next earnings event, all of the average daily value, market cap, short interest levels. You can hit the live interactive charts. You have the data on the post earnings page. What you don't have as a free member is access to the tools. There's limited access to the earnings calendar, but there really isn't. You can just see the stock screener, but you can't pull up a report. You cannot use our back tester as a free member. And, and you cannot use all of the customization factors that you'll see. But what you can do, you can go to our Option Slam webinars and you can see all the past recordings of all the different webinars. So I can go in here and try to find out, when did I bring that ZIMS trade up the very first time? Well, here's new strategy for big moves. This might be it right here. This might be the first time I introduced the ZIMS trade. Okay, so that was just a couple months back. All right. So anyway, let's go back to tons of webinars here. And as an insider member, you can have access to the recordings of all these different webinars. So I don't talk just about ZIMS trade and some of the, ZIMS trade. Who ever heard of the ZIMS trade? Nobody, because I just made it up. I'm not saying I invented the strategy, but I made up the name to a strategy, and I've defined some characteristics about how to use the ZIMS trade, how to set it up, et cetera, et cetera. So anyway, you can see as I scroll down here, there's lots and lots and lots and lots and lots of webinars. Butterflies, iron condors, my favorite, the double eagle, et cetera, et cetera. So now I'm going to go ahead and log in so that I have full access to all the tools and data, including the backtester. Let me log in. But you don't have, you can get used to our site and use the site. There's a lot of usable data as a free member. Okay? All right. Any questions or comments? Any suggestions, things you want me to talk about or answer any questions? Please get them typed into that question box. All right. And then let's see. All right. So some people have called me out and says, Marko, you're lying. There's no way you can make over 2,000% profit in a trade. It just doesn't happen. That's just, well, I'm here to tell you today that it happens all the time. It happens all the time if you know how to do it. So before we get into that, let me just show you. I just mentioned that we have a back testing tool, and let me bring up the back tester here, and I ran this back test already to show the results of the PLTR ZIMS trade that was put on November 4th. Okay. This is out of the back tester, but this is the exact trade that we designed in the last webinar on November 4th before the earnings came out. This is the exact trade. Now, when we priced it out during that webinar, it priced out at $65. By the end of the day, we were able to get filled at $62 on that trade. All right. And here's the results. Profit, P&L in terms of dollars, P&L in terms of percentage against risk. Okay, and there it is. I'm not going to spend a lot of time here. Let's move on. But there's the proof for you. Put it in any back tester you want. Put that trade. What is it? It's the ZIMS trade. It's a 2 times the implied move long strangle, buy the 31 far out of the money put, buy the 52 far out of the money call, debit $62, The very next day, it is more than what? 167% profit against risk. Okay? Now, all right, let me take that off and let's go back to where does that silly name come from? What does it mean? Let me get through this slide. 2 times the implied move long strangle. Yes, our website is focused on earnings events, on stocks. Yes, that is our main focus, is trading earnings. Absolutely. 2 times the implied move long strangle is 2 times 2x's, 2x, the implied move strangle. How would you pronounce XIMS? Well, X as in xylophone is pronounced as a Z. Xylophone. Therefore, I would say ZIMS. And that's how I came up with the name, the ZIMS strategy. 2 times the implied move strangle. Okay? Today's strategy, the ZIMS, is a delta neutral strategy. In other words, I don't care which way the stock goes. Stock can go up, stock can go down. As long as it goes, that's all I need to be a winner with the ZIMS strategy. It can win in either direction. We are all familiar with the straddle. Straddle is probably one of the most well-known strategies, next to the covered call probably, that there is out there. Iron condors are pretty popular. Touted by many to be the best earning strategy because it can win in either direction. That's the long straddle I'm talking about here. Many, and I promise you, I'm not promoting the long straddle. I am not, let me repeat that in capital letters, I am not promoting the long straddle. However, the at-the-money straddle is expensive. It is said to be priced to perfection, and that is the reason. What does that mean? Priced to perfection. Options, in many cases, not just the long straddle, but the long straddle is probably the best example of price to perfection. And without getting too deep in the weeds on it, it simply means that the market is highly accurate in determining what the implied move is, where price is about to go, and it's based on the cost of the at-the-money straddle. And if you buy the at-the-money straddle and you place it on a bell curve, if you will, that illustrates, and I meant to get a diagram in here, but I didn't have time to find one to put in this PowerPoint. But of course, imagine a bell curve. Oh no, I'm not going to do that. I was going to draw one, but no. Let me just say this: 68% of the time, which is 1 standard deviation, right? 68.2% of the time is 1 standard deviation. Price moves inside the 1 standard deviation. Okay, so 32% of the time, only 32% of the time does price move beyond 1 standard deviation within the expected time frame, whatever that time frame might be, whether you're trading the front week weeklies, the front month monthlies, 3 months out, leaps a year out, whatever the case might be. Again, in a short 1 hour webinar, it's we can't get too deep in the weeds. The long straddle suffers from implied volatility crush. Well, I'm going to talk. I want to talk about the implied volatility crush. The probability of profit is not favorable, as I just mentioned. The long straddle is going to be, you need to overcome a couple things. Not only do you need to overcome the implied move and the one standard deviation, but you also need to overcome implied volatility crush. Okay? So the valley of death, that is, I am going to go ahead and draw a picture now. The valley of death, can I do that? Here's what a long straddle looks like, right? Like this. And the break-even line being like that. There's the valley of death, right? The valley of death is below the zero line, below the break-even points, which are here and here, is what is sometimes called the valley of death. And the slope is deep and steep. And this right here is the cost of your straddle. And if the price doesn't move at all, you are exposed to maximum risk there. So let me move on. Similar to the straddle is the strangle. Getting back to the ZIMS trade. With a strangle, we buy out of the money strikes rather than the at the money strike, like as in the straddle that I just tried to illustrate. We buy out of the money strikes rather than at the money strikes. This is less expensive. The premium paid for out of the money contracts, the further away you go from price, the cheaper options get. There's a price chart of November 4th, 2 weeks ago when we designed that trade, and here's the outcome of what happened since then. Here's today. But today we're going to look at PDD as a potential ZIMS candidate. So here's PDD. Let's go to the options chains in PDD. Let's just quickly look at the 2 weeks out, and I'll explain why we're looking 2 weeks out in a bit. But here's the at the money. 117, right? There's the current price, 116.75. And so the closest, round that up to the 117. As you can see, price, the premium of options, bid ask, is expensive at the money, right? And then when you go out of the money, further away from price on the call side, when you go out of the money, prices get cheaper, okay? And also I want you to notice that Vega gets smaller when we go further out of the money, okay? At the money is where Vega is highest. And then on the put side, over here on the put side, again, the premium to buy the put is expensive at the money, but as we go out of the money, the premium gets cheaper, 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 and guess what? Vega gets smaller, smaller, smaller. I'll come back to that, but I just wanted to point out that the Vega factor, that is that portion of options premium, which is affected by implied volatility, hence and therefore IV crush. Strangles are less expensive and provide a wider profit window, a wider area within which to win. Jump back to PDD and let's just look at a at the money straddle, which is the 117, if we analyze by that straddle, it has a profit window not including any implied volatility crush, not including anything, looking only at the expiration day risk graph, which is this blue line, which illustrates the P&L risk graph on November 30th, which is the options. Let me delete this slice here and delete this slice here and unlock this price slice for the at the money. So this is the profit window here is above 128 if held all the way to expiration. Now the changes with the today line, okay, but just to keep things simple and just to illustrate certain specific points, if held, and I'm not recommending that you should buy a straddle or buy a strangle and hold it to expiration day, even though that is exactly what worked out perfectly for Palantir. It just happened to work out perfectly for Palantir that the longer you held it, the bigger the profits got. Let me finish this point here. Here's the profit window. Let me put a price slice. Okay. Let's just quickly compare because I need to move on. Let's also now look at buying an out of the money strangle, which is going to be, I don't know, let's just go 10 points out of the money, 117 to 127. So let's buy that, 127 just to illustrate, and 117 minus, and let's control by that. And so then now I've got a strangle and I've got a risk profile. Now my, you can see my break evens are on expiration day are there and there, as compared to the straddle, they're narrower. You see there's the break even there, and there's the break even there. So the wider I go with a strangle, the wider the break evens are going to be. So, okay, so let's go back here. Okay, this is less expensive and provides a wider window of profit, typically done at the implied move away from price. Okay, I'm not sure what I meant by that or where I wanted to go with that, but today's strategy takes the strangle to a new level. Let's look at double the implied move strangle, 2 times the implied move strangle. What is the implied move again? It is the price of the at the money straddle. So the price of the, let's see, let's go here. What do I got here? I got the, I think I'm, let me refer this back to a front week weekly. Let's do the 1122s here, not 1129. 1122s. All right, let's look at the 1122s. Let me take this strangle out of here. The at the money straddle, front week weekly, expiring this Friday, 117 is $10.50. Okay, so double the implied move would be $21. $21, right? $10.50 times 2 is $21. So keep that in mind, because that's what we're going to illustrate here in a moment. This is a very cheap bet, and it comes with potential for very high reward, as in the Palantir trade. a very cheap bet, Palantir $62, $65, returned $1,377 in 9 trading days. The obvious downside is that it is a low probability setup. Low probability. It is a lottery ticket type of a trade. Let me be very clear. You can put on 10 of these and it's very possible that all 10 will lose money. What's the good news? It's also very cheap. So you don't lose very much money when you do lose. And there is a way to manage your losses. I certainly don't have time to get into how to manage profits and manage losses in a short 1-hour webinar like this. But there are ways to manage your losses as well as your profits and parlay your profits into even more profits. If you know how to, if you have some experience trading and you know how to, and you understand options well, you can manage your trades to reduce losses, minimize losses, and manage risk, and sometimes even extend or expand your profit potential in a trade. Steps to enter a ZIMS trade. It's very easy to enter the ZIMS trade. That's what I was just kind of going through there. I didn't quite finish, but here it is laid out in black and white, or in this case, green and white. Determine the implied move of the front week. Well, we just did that. The implied move was $10.50. Double it. That's how we came up with $21. Go to the options chain of the following week, not the front week. Give the trade a little time to work. We want to keep it cheap. We want to keep it inexpensive. So we don't want to go too far out in time. But we want to give the trade a little time to work. And it was perfect in Palantir, the way we did it. Add the implied move. I should say add the doubled the implied move. In this case, it was $10.50 times 2 is $21. Add that $21 to the price of the stock. Okay. I didn't spell this out in black and white as well as I would have liked to. And to discover the preferred call strike. Okay. Subtract the $21 from the price of the stock to discover the put strike. Buy the ZIMS. That's it. That's all there is to entering the ZIMS trade. Let's see. Before we go, let's see what the analyzing candidates for the ZIMS strategy. Okay. So now this is not all the points that I wanted to bring up, but this is the ones I could think of quickly this morning as I was trying to throw this together. Okay. Go to optionslam.com stock screener page. From a list of stocks that are to report earnings, find ones that happen to be in a sector that is hot. What's hot right now? AI, right? Stocks that show up on your report that are already in the news. Well, PDD is a Chinese stock, and China's in the news. Stocks in the same sector recently moved big on earnings. Example, DGDLTR. I'll show you this in a bit. This is a great example of. I'll tell you more about this. Let me go in high EVR stocks, but there is a caveat here. High EVR stocks are expecting. Those are stocks. Earnings volatility rating is something that we have at optionslam.com. It is we rate every stock for how volatile it is on its earnings event. So high EVR stocks are typically expensive premium stocks. So low EVR stocks you can sometimes buy that. Well, I shouldn't say sometimes, pretty much all the time. You can buy a straddle or a strangle on a low EVR stock. Let's say you got a stock that is a $25 stock. A $25 stock with a high EVR is going to be expensive to buy the straddle or strangle. Another stock that's also $25 with a low EVR is going to be much less expensive to buy. Okay, so what we're talking about here is the ZIMS trade is a cheap bet, a lottery ticket style trade, low probability. We don't want to spend a lot of money. That's why we're going way out of the money. We know that it's low probability, but sometimes getting those cheap bets by getting low EVR stocks. And just because a stock is low EVR doesn't mean that it can't surprise once in a while and have a huge move. So I'll show you another example too of where that caveat shows up. And that is in the implied move of any given stock right before its earnings. I'll show you that here in a minute. High short interest stocks can lead to short squeeze. So that could be an opportunity. A stock that has high short interest can be an opportunity for a ZIMS strategy. Okay, so let's get back into optionslam.com and let's take some of those steps. Let's go to the earnings page. Let's go to the stock screener right there. Earnings page, stock screener. I have some presets here. This tool is not available to free members. You need to be an insider member to use this tool. You can see the tool, but you can't actually use it. I've got some presets here. I'm going to use my generic scanner. Now you can use some of these other filters to find stocks that have moved big before, okay? But I prefer just to use this and just kind of scan the list of stocks, okay? Scan the list of stocks. So who's coming up within 1 week that's priced over $20, that has weekly options, and trades a minimum average daily volume of 2 million. That's my criteria. That is all listed basically right here in this section, and is going to be reported within 1 week of today. So that's my generic criteria, and I get 14 stocks come up, and PDD is on that list. But let's look at some of the columns. What sector is it in? Okay. What is the EVR? So here's what I saw. ZIM, that's funny. ZIM is a stock with the same name as ZIMS, and it has one of the highest EVRs on the page here. Now, I looked at that stock here recently, and I don't think it's really very liquid. I think those far out of the money options have, some of them even have a zero bid, wide bid-ask spread. So I'm not going to focus on that. But let's look at this list here. Ross, here, starting. I don't know, Futu, I don't think that is super liquid when you get far out of the money. Lowe's is a low EVR stock. Does that mean it's never a good candidate for a ZIMS trade? Well, not necessarily, and not to spend a lot of time on it, but let's go ahead and let's go quick look at Lowe's and see if it's a candidate for a ZIMS trade. When we go open up Lowe's, we go automatically by default to the earnings history page. I'm going to quickly jump over to the implied move weekly page. And here I can see the final implied move for all of these previous earnings events, the November, the August, the May event, the February event. And this thing really just kind of sticks there at 4.5. A while ago, it was up to 5% implied move. What does the actual 1 day move do? Inside the implied move, inside the implied move. I for inside, O for outside. But outside momentarily during the first trading day after the earnings event, but then by the end of that day, it was inside the implied move. So this is all, now here's a case where it moved outside the implied move and stayed outside by the end of that day. But a 4.2% move, implied move, which was $8.62, a lot of data here. $8, double the implied move would have been a over $17 implied move. Well, that would have been an 8% move. And it did move up to 7, but that wasn't enough to make that a profitable ZIMS trade, was it? So I don't see a profitable ZIMS trade on this sheet at a quick glance. Now there's 5 more pages. Okay, there's 4 more pages, but without belaboring that point, let's go back to our list. So I can quickly scan my list of stocks here and determine whether it's a candidate for the ZIMS trade. Now, is that how I would do it? No, because I'm not always looking for candidates for a ZIMS trade. I might just be looking at the, this is a case of what came first, the chicken or the egg, right? And well, what comes first? Picking a strategy and finding a stock to fit it, or picking a stock and finding a strategy to fit that stock. So I might be thinking, well, a lot of people want to trade NVIDIA today. I'm not interested. Too much hype. I'm personally not interested. Is it a candidate for the ZIMS trade? My guess is probably not, because I think the options are going to be priced too high. But let's take a look. Let's go ahead, right click on NVIDIA and open that in a new tab. Let's take a look. And this brings me to a point that I kind of alluded to earlier. I'm going to jump quickly, immediately right to the implied move weekly page. And I'm going to look at NVIDIA implied move compared to NVIDIA's previous implied moves at previous earnings events. What better stock to compare NVIDIA to than itself? Now, the implied move is currently at 9.83, but the earnings don't come out until the 20th. That's 2 days from now. We got the rest of the today, all of tomorrow, and all of the next day for this implied move to change. This is the at the money straddle implied move. By the end of the day, Wednesday, this 9.83, I'm going to guess that it will come down from that. Now, why? Simply because of theta decay. Simply because of time decay. Oh, Marko, it's only 2.5 days. It makes a difference. Now, is it possible that it'll be more than 9.83, even though there's time decay? Yes, it's possible, because there could be a huge rush, a huge build of implied volatility, which also affects options premium, which could cause the option at the money straddle to go up from 9.83. But more often than not, option, and I've got a chart right here that I can prove that to you. out of the last, let's see, 2, 4, 6, 8, 10, out of the last 12 earnings, that's 3 years of earnings events. Only once did the implied move go up in the final couple days to be above what it was. Okay, only once do I see any evidence that the implied move got a little bit bigger, and it actually ended up right where it started a month before. If you want to go see the data and understand this deeper, I just don't have the time to get into all the meaning of all these charts and all these tables and every detail. But believe me, there's webinars that do. There are webinars that in our webinar archive found under the right here, Option Slam webinars under the resources tab. I get into all the nitty gritty details of all the data at optionslam.com. And these candles provide evidence to you that implied moves start. Here's one perfect. This is very typical. Start here a month before the earnings event and get cheaper as the month goes on, to the final implied move being at the low of the candle. And you can see that is very typical of all these earnings events. The implied move gets cheaper even though implied volatility goes up. Implied volatility alone is not enough to compensate for time decay. So again, I digress and I'm getting too deep. Let me see, where was I? Okay, NVIDIA. So NVIDIA, where is NVIDIA? 9.83, let's call that 10%. Let's call this one 11%. 8, 9, 7, 10, 7, 6, 8, 6, okay? Well, we're at the higher end of the range, aren't we? We're at the very higher end of the range. We're in these 9, this is a 10. The highest I see on the board is an 11. This is a 10. So just as I suspected, NVIDIA and the premium to buy the at-the-money straddle, the premium to buy any option is higher this earnings event than it was in most of these earnings events because they all had lower implied moves. Implied move is just a function of implied volatility, okay? Implied move is a function of implied volatility plus time. All right. So if there's high implied volatility, option premiums are higher. So I like buying a ZIMS trade when the option premium is low. I want to get in cheap. I don't want to pay the highest prices. All right. You say, well, Marko, you did the Palantir trade. That wasn't cheap, PLTR. Let's go look at it. So I had that question come in. What was the, whoops, I want to go to implied move weekly. So what's the Palantir, implied move on the Palantir trade? Well, actually, it was not too bad. It was at 13% implied move. Whereas the previous 3 events, I should say, were all at 15, 15, 15, 15. Here's a 12, 15, 14, 14, 15, and it was at 13. So it was on the cheaper side. It wasn't really cheap. It was still expensive implied volatility, but it wasn't the most expensive. So this is something that I look for when evaluating whether to enter the ZIMS trade. Okay, so Palantir kind of fit the bill with that. Okay. What else do I want to look for? Lost my train of thought on that. Let me go back to. Oh, I finished that. Okay. All right. Well, let's go. Oh, let's go back to PDD. Oh yeah, we were at PDD. Let's go back to PDD at Option Slam. Sorry, I lost my train of thought. Let's go back to PDD And let's continue evaluating that. All right, so I got sidetracked, showed you some illustrations and examples of some of the things that we look for. So where is PDD right now? Let's go to the implied move weekly. Is PDD got a high implied move or a low implied move compared to itself in previous earnings events? Well, it's currently sitting at 9. Okay. Last quarter was at 8. Another 9. Here's 12. We round that one up to 10, to 10, to 12, to 11, 11, 12 and a half. So it's kind of at the lower end. It's kind of at the lower end. It's not at the bottom. There's the lowest one I see on the page is 8. There is one more page of PDD, Pinduo Duo. Okay. I think it's called PDD Holdings, but I think PDD stands for Pinduo Duo. This graph shows you that this stock you can quickly see at a glance that this stock has the capability of moving outside of its implied move. The implied move is this orange candle, this orange vertical rectangle. That's the implied move. If I hover my mouse over, it tells me the implied move was that, and the actual move was that. So again, not to spend too much time because we're going to go over time a little bit here today for sure because I haven't covered everything I want to cover. I'm trying to get into this deep enough for you to get a more deeper understanding of the analysis that goes into, should I do this? Should I see, if you go to the local corner store to buy a lottery ticket, you are truly gambling. But if you analyze data and information, you can gamble a lottery ticket type of a trade, like a ZIMS trade, with an edge of having the knowledge of what's happened before, where do the conditions sit today in relationship to prior history. And you can go into this as an informed trader and know exactly what your risk is, because you can't lose any more than you spend. And if you're not comfortable spending $62 to buy a PLTR trade, you don't need to spend it. You can just pass and look for a better setup, knowing that it's unlikely to hit and that the odds are that it will lose money. But the idea with the ZIMS trade is that one huge winner can pay for many, many, many small losers. And that's what they are. They're small losers. And there are ways to minimize your loss. You know right away, as soon as the earnings comes out, you know right away likely whether this is going to be a winning trade or not. You don't know for sure. You have to give it a little bit of time to work. Okay, let me go on. I'm sorry, I digress again. Here we are. We're on Pinduo Duo. We're on the implied move weekly page. By the way, the implied move weekly is posted right at the top of this page. It's currently sitting at 9.4%. It's also posted down here in the table. So we're okay with this. The price of the at the money, the implied move is at the lower end of the range. So this is evidence. Now, what else do I want to look at? Does PDD remember Lowe's? Lowe's never showed us any evidence that it could ever really have a blowout earnings to the positive or negative side. The historical data told us that it looked like every one, had you tried the ZIMS trade on Lowe's, would have been a loser. But let's look at PDD. Implied move of 8%, actual move of 28%, 1 day move. Implied move of 9. Oh, and the actual move of only 1. That's a loser for sure. This is a winner with the ZIMS trade for sure, right? 12 and 16. I doubt that even at the max move, the max column, I doubt even at that point that would have been a winner. But here's one that probably was a winner, at least the first day. Now, here's one that was a winner, at least at some point during the first day. This one's questionable. We have the back tester, though, where you can go find out. You can go find out. This definitely was a winner, at least at some point during the day. Did it end up at the close of that day being a winner? No. Probably by the end of that day, this was a losing ZIMS trade. It's not enough of a move. Okay, so this is the 1 day move. We also have another page that is very important for you to be aware of and take into. All these different pages in this black bar are related and specific to the stock that we chose, okay? So here's the post earnings page. So here's the 1 day results, which we just saw. But now we can go out further in time, 3 days, 5 days. Here's a week out in time. Here's 2 weeks out in time. This is the column that we want to focus on PLTR because, or almost all ZIMS trades, it depends on when they report, because PLTR reported on a Monday after the close. So Monday after the close, and we're going out 2 weeks with to the 15th on PLTR. We want to focus on this column. But if you've got a stock that's reporting on a Thursday, or here's a Friday, and you're going out to the following week with the ZIMS trade, you might want to go out 2 weeks for the ZIMS trade, okay? Usually we go out 2 weeks, but in this case, when you're reporting on a Friday, you might not want to go out just to the following Friday, but 2 Fridays beyond that, or to the front monthlies, the closest monthly expiration. So depending on when the stock, if it's reporting early in the week, I'm going to go to the not the front Friday, not the front week, but 1 week beyond. If it's reporting towards the end of the week, like this example here, you might well be advised to go out 2 weeks, okay, beyond this. So I would go May 26th plus 14 days to choose that expiration cycle. All right, I hope that I didn't mean to. All right, what else do we have? Okay, so let's go back to PDD. Let's finish designing our trade. We said that the implied move is $10.58. Double that is $22. 1050 times 2 is $22. Are you with me? What are we going to do? That's the front weekly. What we're going to do now is we're going to go to the next week out. We're going to go 1 week out beyond this Friday, and we're going to go $22. We're going to take the price of the stock, which is $117. We're going to go out $22 on the call side. So we're going to go 117, 27, 37, 39, and we're going to buy that call. And then we're going to take our 117 and take our $22 and subtract it. So we're going to go down to the 107, 97, 95, and we're going to Control key in Thinkorswim, buy that 95. So did I do it right? 1/2017, 27/37/39, 07, 97, 95. Yep, that looks like I got the right strikes. So here you are with a ZIMS trade, a ZIMS setup. It's $112. You can't lose any more money than that. And reminder, you are likely to lose $112 or somewhere close to that because it's a low probability trade. Let's go to the risk profile and take a look at what this needs to be. Let's add the implied, let's add one standard deviation so we can see the probabilities of one standard deviation out to November 29th. The 30th is when those options expire. So there's one standard deviation in that shaded area. And let me delete this slice so we don't confuse anybody. Any comments or questions about this so far? Any comments or questions? Okay. Let's see. So there's what the trade looks like in risk profile. Okay. Now, I want to talk about implied volatility crush. Because when we're buying options right in front of a earnings event, we know that options, long options, options that we buy, suffer from implied volatility crush. Well, what will happen? What happens with the at-the-money straddle? It really suffers from implied volatility crush because why? What we looked at earlier, the at-the-money options, 117s, have a vega of 8. Let's go over to the put side. A vega of 8. Whereas our options, 139 and 95. 139 on the call side. Look at our vega here. Half that of the at the money. Okay? Half that of the at the money. 4 instead of 8. And the 95, a 2 vega. So does my long ZIMS trade suffer from implied volatility crush? Yes, it does. But to what extent? Less than half. Let's call it a third, therefore. Let's call it about a third that of the at-the-money straddle. So, an interesting point. An interesting thing to be aware of. Also, theta decay. The theta, the time decay of these far out of the money options is also less than that of the at the money contracts that are suffering theta time decay at 26 cents per day initially, compared to our ZIMS put is only losing 6 cents per day initially. All right, let's see. A couple other things I'd like to show you, some examples of, all right, so any questions? I don't have any questions, and I didn't think I was that good at explaining stuff. Are you guys still out there? Are you with me? Right? Okay, all right. All right, some more stuff I want to, hey, Joe, good to see you, man. All right. All right, I got a couple other things I'd like to illustrate. So, how often can this pay off? Well, we just saw in Palantir, which the options expired last Friday at 2,100% profit. How often can that happen? Well, let's look at when I first introduced the ZIMS trade. A while ago, I think it was a month ago, we had Dollar Tree was on our list of stocks to consider. And I said during that webinar, I don't know, Dollar Tree, and here's a price chart of Dollar Tree. Boom. But I was saying, I don't know. Dollar Tree on the ZIMS trade, Dollar General just had a huge move down. And so in that webinar, first introducing the ZIMS trade, I said, Dollar Tree, I don't know. I'm a little skeptical because look what happened after Dollar General had their earnings move on August 29th. And on that day, Dollar Tree on August 29th gapped down in sympathy with Dollar General. And I thought, and I said, I'm not comfortable with this one. I don't think I'm going to do this one because it's already moved down substantially. Even if they do have bad earnings, it's not likely to be a winner with the ZIMS trade. Well, I did a back test on it. Guess what? Dollar Tree, ZIMS trade, $135 along the 65. This is the ZIMS trade set up. Now the strikes weren't perfectly available. The actual strike should have been the 62, but they didn't have a 62. 65 was the lowest strike available, and it should have been, I think, 102, but that also wasn't available. So since I came in a couple bucks on this side, I thought just to balance things out, I'll come in a couple bucks on this side. So here's the Dollar Tree ZIMS trade. The day or two after I said, yeah, I'm not comfortable with this one, I'm not going to play it. $135 bet, guess what? Returned 100% winner overnight. And that's by the end of the day. Earlier in that day, it was actually even further down. You can see the low of that day was actually lower than where it closed. But still, held to the end of the day, was 100% winner. Now, as often happens with ZIMS trades, I lost that. Let me go back to it. As often happens with ZIMS trades, you need to manage your winners and your losers. But so in this particular case, if you didn't manage the winner and take at least, now, see, there's ways you can incorporate buying and selling stock, okay, to the term is gamma scalp. There's ways you can take partial profits by buying and selling stock, buying or selling stock, depending on which way the stock went. You can do some gamma scalping with stock, or if you buy more than one contract, you can take one off. If you did two contracts, right? You can take one off, and now you're holding one for free. that kind of thing. There's gamma scalping with stock. There is also hedging by rolling your losing side or selling against your losing side. There's a bunch of things you can do to manage these trades to either reduce losses or improve profits, or at least take some risk off the table. So Dollar Tree, I was dead wrong about that. Let's let's take a look at Dollar General. This is just from last quarter. Dollar General, the ZIMS trade, was a $98 debit. It returned a max return of $2,009. If you put that in percentage terms, we'll just put a little formula in here, equals profit divided by risk equals that. And let's put a little dollar sign in there so that we can copy that formula down, because our risk stays constant at $98. And let's convert that to percentage. Okay, so one day, 1,700%. Max profit, 2,084%. Now this I could have done this one out another week, which would be another 5 days, 5 trading days here. So that rule about buying the following Friday out, I should put parentheses or an except statement, except when the earnings event is later in the week. Then maybe you should be buying 2 more Fridays out instead of just 1 more Friday out. Okay, I'll adjust that in the setup rules. Okay, I'll make that adjustment in the setup rules so the next time we talk about it, I won't forget to mention it. All right, so there's Dollar General and Dollar Tree, good example. Let's look at PDD. Last earnings, PDD. Let's put our formula in there. Here I got my formula. I can just copy this formula. Let me copy that formula from Dollar General and paste it right here in the PDD. Oops, nope, I meant to paste. If I paste all, does that give me my formula? Yes, it does. Okay, PDD, last earnings event. Mind you, they got earnings coming up here in a couple days. 1,600%, 2,000%, 2,700%, even better than Palantir. So how often does this happen? It happens often enough that a big winner will pay for many, many, many of your small losers. In this particular example, do the math. This winner at that level paid for 27 $100 losers. 27 $100 losers was paid for. Now, do you have to trade 27 times to get a winner? I don't know. I don't have hard statistics on that. But what you can do is, you need to really, to fine tune it, you need to use our back tester. You need to go, let's take a look at, who else do we have? Well, that's all I have fresh examples of that I've done. Let's go back to Option Slam a minute. And let's go back to our list of who's reporting this week. And see who else we got. Well, Now, here's TJ Maxx, a 1.9 or a 2-point EVR, and also Ross Stores and Gap. Okay, so we got all these retailers. Who else? Um, Pan W and Snow are candidates. I'll tell you, there's a lot of candidates that I would like to evaluate closer. I think a lot of these you'd have to go and look at the Option Slam data and dial in on it. Okay. Which one should we? Let's look at. Well, Gap's got a high EVR, and Ross Stores a 3. Let's go look at Gap. Didn't that used to be different call letters? I think that used to be GPS, Gap Stores, right? Anyway, let's go look, Gap. Okay, here it is. So here's Gap. It takes me to the earnings history page. Let's do a quick review. It's got a high EVR. So you can see last quarter it didn't move much. The quarter before it moved huge. 8% move, and then a quarter before a huge move. Okay, let's go look at implied move weekly page. That's more information there that relates to what's being priced in this time. So let's look at that. 13% right now. They're not reporting for about 4 days. Okay, 3.5 days from now. 13%. Here's a 12. Here's almost a 15. Here's a 12. Here's 13, same as what we are today. Here's a 15. Here's a 12. Here's a 13. Here's a 10. We're right in the middle. We're right in the middle. 13 is right in the middle of the low 10 and the high 15, 16. We're right in the middle, not low, not high. So implied move is the price of options is, it's not too expensive, it's not too cheap. So how often historically did the ZIMS trade pay off? This is a ZIMS winner. I'm pretty sure. Let's go back test it. Let's go back test that one. Let's see what else. This one for sure is a ZIMS winner. This one for sure is. On the first day only. I'm only looking at the first day. If you want to look holding it longer, don't forget, you go to the post earnings page, and this will tell you if you hold it for a week to 2 weeks, did it hold those moves? Now here's one that started out not winning on the ZIMS trade, but 2 weeks later, look at it. Boom, that's a winner. Okay? That's a winner. Even this is a winner. Okay? So just because the first day doesn't pay off doesn't mean that it didn't win. Okay? So you can't just look at the implied move weekly only page. You have to come here and see what else happened. All right? Here's the first 1 day move, and then held for a week. It improved, held for 2 weeks. It really improved 50%. This is a huge ZIMS winner. Here's a ZIMS winner. First day, 7, but held 22. Okay, for a week. By the time he got here, I don't know. You'd have to back test it. You would have to back test it to know. Okay? Is this making sense? Does this make sense? The number of outstanding options is very low. Matthias says the number of outstanding options is very low. Are you referring to open interest? I don't understand the question, Matthias. Please because I want to answer that for sure. The number of outstanding options. if you're referring to, or maybe liquidity, open interest. Okay, open interest. All right, open interest. People worry about open interest. Should I trade this? All right, let's go. I think you're probably referring to PDD. Let's go because I don't think we dug into. Okay, don't. Okay, can't. Let's close this. Close this. Close this. Close this. All right, let's go back to look at PDD. Honestly, I don't worry too much about open interest. I worry more about bid-ask spread, and I use bid-ask spread to determine the liquidity. Volume is important. Open interest is worth being aware of. But let's see, what are we doing here? We're going to the 29th. We're looking at the 95 139s. Let's go take a look at the open interest and volume. On the 29th, there is on the 95s, let's find the 95s here. There is 55 open interest, 24 contracts traded today. The bid-ask spread is not tight. It is not tight. It's not 26 by 27 cents. It's not 38 by 39 cents. It's kind of wide. I use a tool let me add my normalized bid-ask spread. And this is something that I had a webinar about. Let me customize this. Let's customize this and add my normalized bid-ask spread, which is my, where did it go? Oh, I'm in my paper trader. I don't have it loaded in my paper trader. I'm sorry, I don't have it loaded up in here. But I do have the a webinar. If you look in the webinar archives, I've got a tool called the normalized bid-ask spread, developed by my good friend Patrick McMillan, and we got a webinar about that, and you can add that right to your toss columns here. Okay, my guess is this is probably about a 35 normalized bid-ask spread, 0.35. I'm just wild guessing it, and that's not very good. It's not. It's probably not a very good. The lower the number, the better. So, are you able to get filled at a fair price? Are there? It is low open interest, but can I get filled at a good price? The reason I don't worry about open interest is if price goes to 95, there will be open interest when I'm ready to close the trade. I guarantee you. If price goes there the day after earnings, all of a sudden this open interest will skyrocket. Everybody will be trading it. Okay? So that's why I don't worry so much about open interest in a trade like this. Let's go look at the other side, 139. 139. Open interest, 32. It's, I really like round numbers, and I oftentimes gravitate to round numbers. In other words, the 140, look at the open interest there. The round number 140 attracts open interest, attracts volume. Okay? But I was just designing this trade by the book. So I hope that answers your question, and I hope it makes sense. I don't worry about the open interest in a trade like this, because if price goes anywhere close to the strike that I'm trading, I'm not worried about getting out of it. It's going to be heavily traded. Okay? Because price is there. It's going to be, all of a sudden, it's going to be the at the money strike. It's all of a sudden, it's going to have large open interest. Okay? Avi asks, what about slippage? Yeah, slippage. That's exactly what I'm talking about. Very good. Question. What about slippage? So can I get filled at the midpoint price here? The midpoint price is what? 16.8, about 31 cents. About 31 cents. Can I get filled at the mid? That's what you're asking, Abby, isn't it? Can you expect to get filled at the mid? Well, with only 24 contracts and only 55 open interest, as Matthias brought up, maybe not. Maybe not. But don't forget, we don't put these trades on today. PDD doesn't report until when? I'm glad we're talking about this, because this is important. You don't put this trade on today. You wait until the 20th. See, this stock reports. Let's go back here a quick minute. We were going to look at gap, and we got sidetracked with some questions. We'll try to come back to gap. This reports the 21st before the open, so you have to wait until the 20th to trade this. The last opportunity to trade this is the 20th before the close. I would wait until the final hours, 2 o'clock Eastern time, 3 o'clock Eastern time, very likely is what I would wait on the 20th before I entered any through the earnings trade. Even if you're going to enter an iron condor or a short strangle or a whatever your strategy is. If you're going to hold it through the earnings event, you need to choose your strikes based on where that stock closes on the day before the earnings event, or the day of, in the case of an after the close type of a. Okay, so let's see. So what is the slippage? The slippage is, can I get filled at 31 cents here? Somebody's stepping on the ask. It was 39 by, I forget what it was, 39 by something else, 20 something. I think somebody's stepping on the ask here. Can you get filled at the mid? Here now the mid is at 30 cents. The mid is now at 30 cents, right? I don't know. Maybe you have to pay 31 cents for it. Maybe they squeeze you all the way to 32 cents for it. Okay? Yeah, this is not a healthy bid-ask spread. Is there slippage? Can you actually get filled at the midpoint price? Not when the bid-ask spread is that wide. You're not going to get a fair fill. Okay? All right, so yeah, very good point. Thanks for bringing it up. No other questions? Okay, let's go back over to gap. I forget where we left off on gap. Let's go take a look at gap. Let's go look at, all right, so gap. Oh, okay, I know what I want to do. Let's wrap it up. Let's wrap it up with a, let's find one here that looks questionable. 12, this looks good. Let's go to the post earnings page and find one that looks questionable, and then we'll back test it and see how it panned out. Okay, so these are all Thursday. Notice these are all Thursday. So I think what we ought to do, they're after the close. There's only one day to the front expiration. So I think what we ought to do for this stock is not go out to the following Friday, but go out at least to the next Friday after that. Hopefully it's a monthly option, because then the liquidity question becomes less of a concern. Monthly options are usually much more liquid than weekly options. The downside to monthly options, of course, is that they are less strikes available. So we might not have the strikes available. Let's take a look here. Let's see if we can find one that's questionable here. The 1-day move was 28, and then within 2 weeks it was at 17. I would say that this one, I'm going to assess this one. Well, that one's a winner for sure. First day, for sure. First day, that one you doubled your money at least on the first day. But let's find one that starts. Here's one that by 2 weeks later it was a huge winner. It started out as a loser, turned into a winner. I'm trying to find one that's just kind of questionable, and I can see whether it's a winner or a loser and when it became a winner and a loser. So here's one that's kind of questionable because it only moved 7% the first day. Within a week, it was at 22%, but then it gave some of that back. So was it still a winner was it a winner on that day? I'm going to say, yeah, probably. Was it a winner on that day? I don't know. Looks questionable. Looks questionable to me. So let's do it. 8/24 was the earnings date, and it was after the close. So we need to make sure we take that into account. 8/24, we'll go to Option Slam's back testing tool, and we're going to go to gap, and we're going to go to 8, and just change the date here. 8/24, 2022 was that? 8/24, 2022 was that? Gap, 8/24, oh, 2023, sorry. 8/24, 2023, 23, okay. Let me fix that. 8/24, 2023, and now confirm that by looking at the calendar and clicking on 8/24, 2023. Click that. This is our back testing tool. Click on load strikes and expiration dates, and then this fills in. Oh, I'm in the wrong. Oh, see, it says PDD still, and I just didn't I just click that? Gap 8/24, 2023. Okay, maybe I didn't click it. Click that. Huh, what's going on here? Okay, let me refresh this page. Not sure what's going on here. GAP 08/24, 2023. Confirm it. Load strikes. What the heck? All right. Hope you found today's webinar interesting, and that I hope you learned something. All right. Having said that, thank you very much for your attendance here, your great questions, your participation, and look forward to seeing you again next time. Don't forget, optionslam.com@gmail.com. Shoot me an email. Let me know your questions, your thoughts, your suggestions. What would you like to see in a webinar upcoming in the near future? In the meantime, wishing you all good trading.